Okay guys, one of the most common questions I get, and we get as a channel, is how do I calculate the value of a stock? So a lot of value investors, and Warren Buffett, you'll hear him talk about this all the time, is what's the intrinsic value of a company?
Yep.
Investing is not a science, it's an art. It involves a lot of scientific methods such as numbers and things like that, but it's an art. Warren Buffett and Charlie Munger always say, if you ask each of us to come up with our own intrinsic value of Berkshire Hathaway, we'd have different numbers. How close can they be? I don't know. But intrinsic value for a company is basically the value you come up with to buy the company. How is that determined? Well, multiple methods. There are so many ways to do it versus price to sales, more complicated valuation metrics and models, multiple free cash flow, multiple earnings. There's many ways to look at it. The way I like to do it is, the reason we created 8 pillars was it kind of forms my mindset of saying, hey, is this company selling for around where I think it should be selling for based on different metrics? I prefer to go with the free cash flow multiple. In any given year, though, free cash flow can fluctuate. So if you guys have seen, I look at a 5-year average. Why do I look at the 5-year average? Well, hopefully I'm buying a growing company. If I can buy a growing company, I would be paying a higher multiple of free cash flow. So there's another example of the art of investing. What multiple is the right multiple? It depends on so many factors. What's the competition like? How secure is their moat, as Warren Buffett calls it? How secure is their business? Is it hard for people to enter or exit the business? Things like that. The higher the margin of the business, the more likely there'll be competitors come into it. So you want to factor that in your multiples whenever you do anything having to do with intrinsic value. But the key here is, when you're looking for intrinsic value, you're not going to be able to get an exact number. In fact, I bet if you took an intrinsic value today of a stock and forgot about the stock, and a month from now did another one, you'll probably come up with a different number altogether. Your number should be around the same every single time, as long as the data is the same. But as data changes, as the company gets better or worse, your intrinsic value will change. As the balance sheet gets better or worse, your intrinsic value would change.
I think some people are thrown off by that.
Of course.
Because we've done videos in the past 6 months where you give one target price for a stock, and then 6 months later, you're giving a totally different number. It might actually be a little bit less.
Yep.
And people are like, hey, how come you said this and it's different? Where they're used to the hype channels, right? That is, my valuation is 6,000 on this stock, and then it's 8,000, and then it's $1 billion.
Yep.
You know, and so you're willing to pay for growth, but it's going to change over time.
Of course. And look at a company like Amazon. Amazon's growth, look at a company like Microsoft. Microsoft growth actually increased over the last 10 years. That's a very rare event for such a large company like Microsoft. If you'd asked me 10 years ago what I'd pay for Microsoft, which by the way, I was one of the few people buying Microsoft 10 years ago when I was told it was a dead company, I thought it was worth $50 a share. I was paying low 20s for it. Then it went to 55. I sold it all. Now it's at 200 and some. Yeah. I look like a fool. But why is that? Because their revenue was growing 10 or 11% before, and now it's gone higher. I was not going to foresee a company like Microsoft increasing its revenue to that level. One of the assumptions I make in a lot of companies is the bigger it is, the slower the growth will be, right?
Yeah.
Now, when you hear intrinsic value, what's the next thing we hear about? We hear about margin of safety. Mm-hmm. So here's the key to it. Let's say I pick a company that I think is $100 value. That's the intrinsic value of the company per share. Doesn't matter. Let's not assume all the other things. Let's assume $100 per. How right am I going to be here? The idea of a value investor is they want to pay $60 for it. Why? Because their comment's going to be, listen, I don't know everything. I need a margin because there's going to be things I get wrong here. And the bigger my margin, if I buy 20 of these, I'm more likely to be right overall as a group than wrong. I'll be wrong in a few. I'll be really right on a few. Where in fact, my $100 value might actually be $130. But as long as I'm buying companies with an ample margin of safety off of intrinsic value, I will do very well. This is the entire thesis behind every value investor. This is why when there are other stock YouTube channels out there talking about how we're not value investors, yet they're paying through the nose for every hype stock out there, that is not value investing. Value investing is about buying at a discount to intrinsic value. So the next comment we get from people is, Paul doesn't care about growth. I absolutely care about growth. The whole point of intrinsic value factors in growth. In fact, if you want to join our software, you will get our stock analyzer tool. And the very first line of the stock analyzer tool is, what are your revenue growth projections? So if you put a stock in, let's say it's Microsoft, it is going to tell you the revenue growth over the last 1, 5, and 10 years annualized. And as you can tell, it has gone higher as time has gone on. This is why I sold Microsoft back in 2014 or whatever for 55, 60 bucks, because I didn't think this was actually going to increase, and it actually has over the last 7 years. Growth is one of the most important parts of intrinsic value out there, right? The key is to find companies like Microsoft in an ideal world that are growing. I think Intel has this right now. They're still growing, but people perceive their future to be very bleak. Remember, the world of investing is all about emotion. Your job as a value investor is to have people not care about that intrinsic value and tell you the market value is actually 60, and you go, no, no, no. If this business was privately sold, I'd be paying $100. Eventually the market will realize it. I'm going to buy it at 60 all day, or 50, or 40, or wherever that number ends up being, right?
Is margin of safety a way for you to hedge?
Absolutely. A margin of safety is a hedge, because we're still human. We're not working in the companies. We can do as much research as we want, and you're not going to get everything right. My personal opinion, which differs from other value investors, is I want to own 20 or 30 companies at an ample margin of safety where over long periods of time, I'm going to be right and I'm going to beat the market because I hedged enough with a large enough margin of safety. Now, one other comment. The bigger the company, I'm okay having a smaller margin of safety. If I'm going to buy a $1 trillion Microsoft versus a $10 million company, which one's more likely to go out of business? The $10 million company. I need a much higher margin of safety as a percentage here than here. I'm okay with a smaller margin of safety for Microsoft. Why? It's bigger, it's more established. It can do a lot of things with its cash. It's spitting off tons of cash. They'll start buying. There's so many things they can do with their money. The $10 million company, it's boom or bust here. Usually the value investor buys a small company based on its liquidation value. And that's another way to look at intrinsic value. If we were to liquidate the entire company, stop the business, and liquidate everything, is there enough money to pay me back? That's a major form of value investing, and it can be very effective. I prefer to buy stable, established businesses that have growth potential in them at a discount. That's more the Philip Fisher way of investing, right? So intrinsic value, it sounds complicated. It can be. Our software makes it easier because it allows you to go put your assumptions in and it spits out a value for you. And that's the big thing for Microsoft, for example. So when I go in here and put all my data in, I won't get into it exactly. You can watch the video here, join our software for 80 cents a day. You get all of this and our Discord channel. It spits out values for Microsoft. And here it's basically telling me Microsoft's overpriced because it's currently selling for $280. And even on my rosiest assumptions, I have a value of $200 a share. So this is another thing I look at it going, based on intrinsic value, I don't need to go any further. I put in really rosy assumptions here. It's not even coming up to the current price. I don't even look further. So intrinsic value isn't about be as specific as possible. It's about that as a value investor, when you see a discrepancy between, for example, let's say Microsoft was selling at $100 a share right now. I'd be looking at going, geez, it's lower than these two assumptions and pretty close to my lowest assumption. I'm probably getting a good deal here. It's not about just sitting there saying, oh, the exact penny. It's about sitting there and getting a general idea of it. Everybody wants exacts, which I get, and I want to be exact with my data going in, but the number comes out, it's more about getting a feel for where the stock stands versus its intrinsic value. All right, so keep watching. This is a very common theme amongst all value investors. If you're watching other channels that don't talk about this in more detail, as opposed to just using cliche terms, ignore them, come learn. It's very exciting, it makes your life easier, and you become a better investor because of it.
Paul, what's amazing is all the other YouTube channels will post things like stocks to buy now, right? And then they want to tell you, this is not financial advice, and then here's the stocks you should be buying. You literally do not ever tell us a stock to buy.
Nope,
not even me, not Nate, not Mo, not Seth. Like, you're never telling us
because everybody's personal,
teaching.
Right? And everybody's personal approach to investing is different. I don't invest the same way that my friend Gary Mashuris invests. I don't invest the same way Warren Buffett invests. I don't invest the same way I read books on value investors, and we all sound alike, but our methods are different. But our fundamental beliefs are the same, right? My goal is to sit there and teach a process, teach you how to fish. You go out there and find the companies that fit your criteria. That is my goal.
Okay, so Paul, this chart here, that Nate is sharing, I saw this, and there was a guy that was talking about this, and he was talking about buying down here, having that 30% margin of safety. And I was like, that's a complete hedge. That's why I asked you that question. And he said, even if you're wrong, you could still make 15%.
So it's exactly correct. The whole idea I talked about buying 100 for $60, even if you're wrong, and maybe it's worth $70, you still make $10. It's like my Carnival Cruise Line bet. I believe Carnival Cruise Line, after diluting shareholders, is still worth between 40 and $50. I just sold puts today on it for $20 that Mo mentioned. Why? Because even if I'm wrong, I'm hoping it's still worth 25 to $30, and I'm completely wrong, I still made money. I bought it at 14, then it's going up. Now I'm buying more, hopefully at 20. That's the goal of value investing. What makes it difficult? You sat there and also asked me, well, Paul, why doesn't everybody want to do it? Everybody
why doesn't everyone want to do it?
Everyone says they want to do it. The question is, are you patient enough to do that?
So if I can buy something and I buy it at the right price, I know that I'm buying a value and I have that margin of safety in there.
You think you're buying a value.
You think.
Guys, investing is like poker. If you have 4 of a kind, are you going to win? You're more than likely going to win. Yeah. You're betting on a probability. But you don't ever, if you play enough hands of poker and you have 4 10s on yours, you'll eventually lose to somebody with a better hand. It might take millions and millions and millions of hands, but that's the point of investing. The point of value investing is you're making bets where the odds are heavily in your favor. You're not always going to be right, but if you buy enough stocks, 10, 15, 20, 30 stocks with the same kind of mentality, you will still win over long periods of time. And that's the idea of value investing. It's to buy at that low level where even if you're wrong, I didn't lose money, because it's a preservation of capital that's very important.
So whether it's value investing, playing poker, playing baseball, as Mo was a great baseball player.
Yep.
You follow the process.
Follow the process, you play your odds, and over long periods of time, you will win. That's it. That's it.
Yep. And
so anyways, guys, smash the like button, follow the like button, join our Patreon so you can have these conversations with 3,600 other people. Yep. It's 80 cents a day, whatever. If you buy that today for $24 a month, 80 cents a day, you're locked in for life. This is literally the easiest this is the best value play you'll ever make. You get the software, all the updates. Please go do this.
Come be a part of the community.
Yep.